Good afternoon and welcome to today's webinar, NDSU Extension Agribusiness's Continuing Agricultural Market Situation and Outlook Series. Thank you for making it here on our first Thursday as we move to a bi-weekly midday Thursday format for the rest of summer. As always, we'll have a series of presentations. You're welcome to use the Q&A tool to ask questions at any time or the chat if you prefer. With that, I'd like to turn it over to Extension Specialist Brian Parman.
Hey, thanks, Dave. So I'm gonna roll with the same sort of updates on unemployment numbers and some of the data that's come out in the last couple of weeks, and then talk a little bit about a report that the Kansas City Federal Reserve put out on meat production just a short time ago. So my first slide I want to talk about is, again, that U.S. positive COVID-19 test rate. And this is probably the biggest piece of data on the virus that we have coming. And the reason I like to focus again on the rate is because, as we all know, as more tests are conducted, you're obviously going to find more infected people. But the test rate determines, are fewer people getting sick, obviously, versus is it accelerating? And in the U.S., we can see a kind of a challenging trend here that's been going on since about the middle of June, which is that the rate of infected persons per test is going up. So it's starting to approach that 10% mark, whereas we were down less than 5% just a few weeks ago. So it seems like more and more people per test are sick, and that's probably why you're hearing a lot of these things circulating as states are suspending their reopening or even reverting back to some of these shelter in place, so to speak, orders coming down the pike because of this positive test rate accelerating. And it's started to throw into question some of the plans we had made for the fall, most notably for a lot of us in North Dakota who are football fans. You know, will there be a college football season, things like that? The Ivy League literally just suspended all fall athletics, so there won't be any fall athletic contests. Now, the Ivy League is not the Big Ten and the Big 12, so you know, the way that they go doesn't necessarily impact all of fall sports, but you know, they were the first mover in shutting down and suspending athletics when this first came about. So my next slide shows North Dakota's positive test rate, and that similar. It's much lower than the rest of the country, obviously, but it has been trending up as well. And in fact, yesterday's or the previous reports positive tests was the highest on record. So we're definitely not trending in the best direction as far as that goes. So again, this is something everyone is watching, and as we think about what the fall is going to look like, the third and fourth quarters, are the businesses going to continue to reopen? This sure throws a challenge that way. So if we look at weekly jobless claims again, the trend has been downwards, but it's kind of leveling off in the fact that we're basically still with over 1 million people per week filing for unemployment benefits. And one thing to keep in mind is, until some new legislation is passed, that extra $600 a week in federal assistance is going away this month. So unless something changes, that'll be gone. And that's many folks have said that has been a huge help, and it going away would severely hurt the economy right now, given so many people collecting, which brings me to the unemployment rate. On my next slide shows that, and it has trended down from the spike in April, but it's still way above where we were before the pandemic hit. So we're still up at that 11% rate, which is historically very high. And the continuous jobless claims basically reiterates exactly that yes, it came down some, but these continuous claims are remaining pretty sticky, as over 1 million people per week are filing for new unemployment benefits, and a lot of folks are remaining on the unemployment rolls as businesses failed to reopen. So I want to shift gears here now and talk some about the greater ag economy, and a report through the Kansas City Fed. And what this is basically showing is the increases in U.S. agricultural exports. That's basically remained limited, as this slide shows, and what's happened with China. And we can see with trade with China, the 2018 and 2019 period, the percentage difference from 2017, 2018 was particularly low. 2019 was poor as well, and 2020 has not yet so far been the boon that we had hoped it would be in 2020. That doesn't mean it won't happen, as Dr. Olson can attest to and explain that they can make these purchases in the fall, etc. But so far, 2020 has not been what we had hoped. And the rest of the world exports, okay, the light blue there on the right has been much lower this year so far as well, most notably due to the pandemic. So let's now, as far as meatpacking plants, something to talk about with livestock prices, and Tim Petrie can elaborate on that a lot more. But just showing a map here, the Kansas City Fed did on positive COVID cases at meatpacking plants, and did they or did they not shut down? And you can see the kind of purple colored ones there in eastern Nebraska, South Dakota, and Iowa, as well as Minnesota, where we had meatpacking plants actually shut down for more than a week. And there were quite a few of them, especially through the Rust Belt there in the Midwest, a lot of shutdown meatpacking plants. And then you had some that shut down for less than a week. Those would be the ones colored in yellow. So obviously this just gives you a visual representation on how greatly this pandemic has impacted meatpacking, and then had these trickle effects all the way through to our live beef, cattle, and hog producers across the country. So looking then, how about capacity utilization at meat packing plants? It's increased. When they shut down, obviously capacity stayed about where it was, but the actual amount of meat going through declined dramatically. But we're still not to the levels of capacity utilization that were around in January and February. You can see pork is still at about 90%, okay? And then beef is about at 95%, that being the blue line. Beef was in the higher 90s in the early part of the year, and pork was close to 100%, and now it's down still, pork down around that little over 90% beef. So we're not slaughtering and packing as many animals as we could yet, and a lot of that is still the challenges that are being felt in the meatpacking industry with dealing with the COVID pandemic. So my next slide, it shows reductions at packing plants, the meat production continuing to lag 2019 levels. Obviously, if you have more plants closed and meat packing plants not operating at capacity, then you're going to have meat production down. And that's what this is showing here. It's a matter of daily cattle and hog slaughter. This is a percentage difference. When we were down around May, we were 30 to 40% below compared to 2019. And again, we still haven't reached that capacity level or percentage, the amount of animals being slaughtered per day where we were in the first part of the year. Okay, so this is down quite a bit, and just showing exactly what's gone on with the meat industry as far as that goes. So my last slide, I want to talk about this. The KC Fed put this out and shows the differences in food consumer foot traffic, okay, at supermarkets versus restaurants. So the blue line shows food consumer foot traffic in 2020, and the sort of darker blue line shows 2019, and that's sort of the reference point. So you can see what has happened when we hit that March and April timeframe. Foot traffic at grocery stores essentially went up 150%. Okay, so it was all the way more than double what it had been in the previous year. And the box beef and cutout price, which is on the right scale, how it spiked, as well as pork carcass cutout price spiked also. I mean, essentially beef going up to well over 100% in price, and pork going up 50% in price. And a lot of that explained basically on the supply side that we had this scenario where fewer animals were getting killed and processed at the same time that people needed to go to the grocery store and buy meat. So some of that was offset, obviously, by the fact that restaurants weren't open and serving the box beef cutouts that they typically do. But you had this supply chain disruption driving meat prices up at the same time that consumers were demanding an increase in meat at the grocery stores, which is where they were acquiring it. And so far, grocery store foot traffic has declined some, but it's still well above where it was this time last year. And again, as meat prices have come down at the retail level, especially box beef cutout prices have come down quite a bit, and pork is about where it was or where it has typically averaged. So pork prices have come down considerably at the retail level, so consumers have probably been experiencing that. With that, I'd like to go ahead and turn it over to Dr. Frayne Olson, who will be talking about our crop markets.
All right, thank you, Brian. So today I'd like to provide a little bit of a preview for the USDA reports that are going to come out tomorrow, and also provide kind of a reflection or an update on what the global grain prices are, and again, how those two are tied to connect together through the export pace. So on my first slide, I just wanted to give you a little bit of background. There's two reports coming out tomorrow. One is the WASDE report, or it's the World Agricultural Supply and Demand Estimates. This is updated every month. So every month USDA provides these forecasts for not only US, but also global supply and demand conditions for major crops as well as the meat products. On the crop side, I've provided a list here of the crops that they focus on for the US. They also provide very similar information for corn, soybeans, and wheat, cotton, and rice. On an international level, they have the major exporting countries as well as the major importing countries. So there's a lot of information. Most of these reports are numbers only. So if you're familiar with what the format for the information, this is a really quick and easy way to be able to get an update on what USDA is forecasting and what their thinking is. And obviously these reports do have a pretty significant impact on grain prices. I mean, we saw that last week or a couple of weeks ago now when USDA came out with their updated acreage report. We had some surprises in that report, and again, that information will be reflected in the data that we get tomorrow. On my next slide, I just wanted to again provide a little bit of context for this release. The WASDE report, again, the supply-demand estimates that we're going to get tomorrow, we'll use the information from that June 30 acreage report. So when we look at planted acreage and harvested acreage for the major commodities, corn, soybeans, wheat, the survey information from farmers that we gathered and reported on June 30th will be included in this. So we are expecting to see some changes. Some of those changes can be anticipated. There's a few that may not be. We're also going to get a production report, and these two reports typically come out together. The production report is really a very detailed layout of forecast for not only yield per acre, average yield per acre, but also total production, not only for the entire US, but also state by state, by commodity. And again, so a lot of people will watch this and say, well, are we seeing some shifts in not only acreage, but more importantly, what's happening on the yield side? Now, for tomorrow's release, the yield estimates are not expected to change from the trend line. So up until this point, USDA has been using a trend line, or basically an average yield that's been adjusted for technology, as the starting point for what do we expect yields to be. The more interesting thing, so we really don't expect USDA to make many changes in that production number. They may make some small tweaks, but historically they haven't made really any major or significant adjustments on the yield side. It's the August report and then later on the September report that are really the ones that people pay a lot of attention to. So the August report for this production estimates now is the first time that USDA conducts a farmer survey asking farmers, what do you think your yield potential is? Okay, so this is really the first kind of ground truth basis that we have for trying to estimate what the yields are going to be. And again, the August one is for corn and soybeans. In the September report, USDA adds another layer of information. They also have what's called the objective yield estimates, where they actually send contracted employees out to selected fields and do a yield survey or a yield analysis, very similar to what a crop adjuster would do to try and forecast yields and project. And so they'll redo the farmer survey, they'll add this objective survey, and in every case, they do use the satellite imagery, or NDVI, the vegetative index information that's been gathered, to try and also in ground truth, or try and make this correlation, saying, well, if we get this information for this particular state, does the information we're getting in that state match up and compare with some of the other states that we're surveying. So they have a whole set of checks and cross checks that they use to try and put these yield estimates together, even though they're still yield estimates, and obviously weather has a lot of role to play in the process. On the next slide, I tried to put together, this is a summary of the survey of private analytical firms, private forecasting companies, as well as a selected number of market traders. And the major news agencies like Reuters and Bloomberg will survey these major forecasting firms and say, what is your best estimation, or what is your forecast for what USDA is going to publish in these reports? So for the production report, when we're looking at bushels per acre as well as total production, the highlighted black line on the very top is what the average trade estimate is for, I think it was approximately 28 firms that provided submitted information. On the very bottom, you see the June 11th highlighted in blue. That's the yield forecast, or that's the kind of trend line yield that's been used by USDA for several months now. So you can compare what is the trade expecting to see versus what USDA gave us last year. As you notice, there really isn't much change in the bushels per acre forecast, but there is some adjustments in the total production number. And again, that's really a result of lower planted acreage that came out of the acreage report earlier on for corn, pretty substantial cutback in corn acres, a small change or small increase in the soybean plantings. So again, the production part of this is not expected to have be major market movers. Most traders and analysts are looking at some numbers very similar to what we saw last month. Now on my next slide, USDA, I mean, these forecasters are also asked, what do you think the ending stocks, the forecast for ending stocks are going to be for both the new crop as well as for old crop? So let's talk about the new crop. That's the one that's growing in the field right now. These Reuters, which is the source that I use, or Bloomberg, will survey these private analysts and say, given all the supply and all of the usage or the demand side of it, what do you think our reserves will be just before harvest of next year? Okay, so we're looking at how much grain are we going to have in the inventory. And again, on the very top with a highlighted black line is what the average trade estimate is. I also provided kind of the highest estimate as well as the lowest estimate to give you an idea of the range. And in the highlighted blue on the very bottom is the information we got from the report last month, the June 11th report. Now, if we go across and we compare all wheat inventories, our forecasts are expected to go up a little bit. Again, this is new crop. We're getting some yield information coming out of the hard red winter wheat belt right now. Yields are extremely variable, but they seem to be relatively stable. I think we're going to hit something that's close to kind of average yields for the hard red winter wheat crop. When we look at corn, again, the average trade estimate is our corn inventories will be down pretty substantially, although we started from very high levels. Again, a big chunk of that will be because of the lower planted and harvested acreage numbers that we got from the previous reports. And then on the soybean side, the average trade estimate, or what the traders or kind of the forecasting firms are expecting to see, is a slight increase in ending inventories for soybeans as well. So based on these numbers and kind of my assessment, I don't think that the private analysts are expecting any major changes in the usage forecasts. But they are expecting some adjustments just because of the planted acreage numbers. So again, we'll have to wait to see on what we get tomorrow afternoon. On next slide, I provided the same information, but this is for old crop. So this would be for the inventories that we're going to have just before harvest of this year. So again, the marketing year for wheat ends on June 1. That's why I provided this final number, kind of the blue one on the very bottom, the black highlighted number, the 1.04 billion bushels on the very bottom. That's a known number. We took an inventory on June 1. This is how much grain we did have in the old crop inventories, and we're going to add in new crop harvest now as we move forward. So the wheat number we know. For old crop, there's still some uncertainty on how much grain are we going to have carried forward from last year into this new marketing year. Now, the average trade estimate, if you compare again that highlighted or bolded black line on top with the blue line towards the bottom, the trade is kind of expecting an increase in ending stocks for corn, and I think a portion of that is going to be probably a slight cutback in ethanol usage. And there may be some adjustment in the exports numbers for corn, for old crop corn. Again, we're gonna have to wait to see exactly what that might play out at, but again, this is what the average trade estimate is going to be. When you look at the soybean column, what the trade is expecting to see versus the number we got last month is very, very close together. So again, I don't think there's going to be any major shock value in some of the old crop soybean numbers. On my next slide, I'm going to shift gears here a little bit and start talking about how competitive right now today, how competitive is U.S. grains in the global market. I'm going to start with soybeans because there's a lot of question about, our ability to be able to sell soybeans in the global market. Are the Chinese finally going to start shifting their buying habits from the Brazilian or South American crop into the U.S. crop? So I pulled some information as of yesterday. So this is kind of the close of business yesterday. And I want to talk just briefly about this slide, and we'll duplicate the same thing for corn as well as for wheat, just to give some reference points. So what I identified was particular ports. And again, I looked up and was able to find information on what is the price or the value of the crop as it's loaded onto a vessel, as it leaves the port, at these different locations. So I picked 4 of them just as reference point for soybeans. I picked the US PNW, which is Pacific Northwest, which is where a lot of the soybeans from North Dakota, western Minnesota, as well as parts of South Dakota go out through the PNW routes. I picked the U.S. Gulf, which really represents both kind of the New Orleans market as well as some of the Texas Gulf Coast ports. There was a Brazilian quote, and I think that quote comes off of whatever is the best price between the 2 major ports of Santos and Paranagua, and then the Argentina river ports. Okay, so if you look at that first column on the left, the FOB, what that means is it's free on board. So that's a price, again, think of that as outbound out of the port. So as the vessel leaves the port, what would be the cost of getting grain on the vessel and ready to leave for whatever destination it's being sent to? So FOB, think about that as, again, as an outbound price. And I listed it both, which is international trade. We typically talk about dollars per metric ton. I did make the conversion to dollars per bushel just because as farmers, we tend to think more in bushel terms than we do in metric ton. Now, if you look down that column of FOB dollars per bushel, you'll notice that the PNW price is the highest of that particular grouping. I mean, when you look at again, what is the cost to get it from the farm through the export terminal and loaded onto a vessel? The bid as of yesterday was about $10.12 a bushel versus about $10.08 a bushel out of one of the Brazilian ports. So again, very, very close. Notice also that the Gulf price was about $9.82. So loaded onto a vessel in the Gulf is much cheaper than it is trying to get soybeans loaded onto a vessel in PNW. However, when we think about how competitive we are in the world market, you also have to talk about freight and ocean vessels. What's the cost of getting it from a U.S. port, a Brazilian port, or Argentine port into the final destination? So again, I looked up what the freight rates were for delivery from these different points to North Asia. That was the easiest one I could find that kind of represented a broad class of countries. So North Asia would include China, it would include South Korea, as well as Japan. And I'm going to use this same freight thing for this North Asia region because that's in our world here in this part of the US, we ship a lot of our product into that North Asia market. And again, I quoted it not only in US dollars per metric ton, but also then converted it into dollars per bushel. So you'll notice now that the PNW, the shipping cost from the PNW into that North Asia market is substantially lower than the comparable prices out of the Gulf or out of Brazil or even out of Argentina. And then the final column, the 2 columns on the far right-hand side, I simply added those 2 values together. So I took the FOB price plus the freight to get the CFR. Now CFR would represent the cost and freight, okay, just kind of an abbreviation. Now sometimes in international trade you might see a price called CIF, CIF refers to cost, insurance, and freight. These prices do not include insurance. Now, insurance is not a huge number, but and it is relatively consistent across locations. But I didn't have that information, so I wasn't able to include it. So think of just as the cost of the grain plus the freight to be able to get it to a particular location in North Asia. So if we look at the far right-hand column, which is the CRF dollars per bushel, now when we make these adjustments for the freight cost, you'll notice that the PNW price is about 22 cents a bushel lower than the comparable Brazilian price. And I think that's now starting to show up in some of our export numbers. There was new information this morning on our export pace into USDA released the export sales numbers. The market had a little bit of a surprise. We sold more soybeans into the Chinese market than people had anticipated in the last week. And so I think we're starting now to see this shifting of business from the South American soybean industry into the North American soybean industry. So hopefully now as we move forward in time, we'll start to see a little bit more regular business out of the PNW, because now we are very competitive from a price standpoint. And on my next slide, I just wanted to give you some historical reference. Now, I didn't include the cost of freight on this. This would just be the FOB price, the price loaded onto a vessel at these different ports. The red line is PNW. So look at the red line being the Pacific Northwest bid. The gold line is a Brazilian bid. And I just want very briefly on the far right-hand side to compare, and let's look at those relative prices between PNW and Brazil a couple months ago. So notice as you get into that April-May time period, the March, April, May time period, you notice that the Brazilian soybean price is much, much lower than it is through the PNW. And part of that, again, is because of the harvest pressure, okay? The Brazilians were harvesting their soybeans in January and February. They're now starting to ship their product, and of course they were being much more competitive right at harvest. But you'll also notice in about the last month or so, as some of that business now has started to wane, as they've been moving through some of their old crop inventories, some of the recently harvested inventories, that price differential between the Brazilians and the US is starting to neutralize. And so now the PNW as a price is getting much more competitive relative to Brazil. So on my next slide, I wanted to show you a little bit of how volatile, how variable are these freight rates. And again, the red line is the freight rate from ocean freight now from the PNW into that North Asian market. The gold line would be the Brazilian freight rates from a Brazilian port into the North Asian market. The blue line is from US Gulf, and then the gray line is from Argentina. So we do see that there is some variability. They tend to move up and down in a general sense together. You will also notice that freight rates drop pretty significantly in that April-May time period, and a lot of that was because of coronavirus and just the economy shutting down and the slowing of the movement of products. So as the product flow started to decrease, obviously the supply of freight was available and prices started to drop. But we're now seeing that recovery as we start to see more export business, as we start to see more ocean freight transfer, and as business starts to recover a little bit, we're starting to see those freight rates increase. So I did want to give some background that the freight rates are not extremely variable, but we do see changes over time. So my next slide is the same basic chart for corn. And I'm just going to jump to the far right-hand column for the sake of time to make sure we stay on schedule here. I do want to comment a little bit because as we look at basically what would be the cost for corn delivered to a North Asian market, you look at the blue, highlighted blue on the top, which is the PNW corn at about $5.18 a bushel versus Brazilian corn at $5.01. So there's about it's a 17-cent differential per bushel between corn out of the PNW and corn out of Brazil right now, and a pretty substantial differential between, let's say, Brazilian price and the U.S. Gulf price, almost 50 cents a bushel. So right now, the Brazilians are very, very competitive in their corn pricing. A big portion of that is because they are now beginning their safrinha corn harvest, or basically their winter crop corn harvest. that corn harvest did, or that corn production did have some issues this later on in the season, but yields are still supposed to be relatively good. The top end has been taken off the yield potential, but again, they're still going to have a very strong crop, plenty of corn to sell. They are going to provide some pressure for us in the U.S. market, and so if there's an international buyer that's looking for corn, they can also go to Brazil and get a pretty good deal right now. On the next slide, I wanted again to provide some historical perspective. I wanted to show a little bit the differential. Now, if you notice, the prices, global prices for corn, again, do tend to move up and down together, but those relative prices do change as well. So if you can see right now, again, the Brazilian corn, that price, if we look back into that February-March timeframe on the far right-hand side, kind of that February-March timeframe, we look at the P&W bid versus the Brazilian bid for corn, they were almost identical. And then suddenly, as we get into this April time period, you see that corn price, the yellow one or the gold one for Brazil, drops very dramatically. And again, part of that is the decrease in prices because of the coronavirus and the economic challenges we're facing. But a lot of it is because that's when that safrinha crop was starting to be harvested. And you notice that Brazilian price for corn dropped much more rapidly than it did for the US P&W bid. So again, we're going to have, I think, for a short time here until we get into U.S. corn harvest, we're going to have a little bit of price competitiveness, some pressure. It's going to be tougher to sell corn out of the P&W until some of those new crop supplies out of Brazil get cleaned up. The next slide is the same thing for wheat. I had to change the locations a little bit based on who's shipping wheat and who are the major exporters. I did want to focus on hard red winter wheat for right now because we are looking at hard red winter wheat harvest, and obviously the size and competitiveness of U.S. winter wheat in the global market has a big impact on U.S. spring wheat. So this is really a winter wheat kind of discussion right now, but I did want to show on the far right-hand side U.S. Gulf hard red winter wheat. Even though we're now kind of in the middle of our hard red winter wheat harvest, which is typically the lowest prices we see during the year, we're still almost $1 a bushel above what you could purchase equivalent quality wheat out of Russia or Ukraine. And again, please also understand both the Russian and Ukrainian harvest are now also underway. So their hard red winter wheat harvest is also going on at this time. And again, the Russians and Ukrainians have a much more difficult time storing wheat for an extended period of time. So they tend to be very aggressive sellers right at harvest. And the U.S. market then doesn't become competitive until that kind of that harvest rush out of harvest push of grain out of Russia and Ukraine starts to dwindle or starts to back off a little bit. So right now, U.S. hard red winter wheat is definitely not in the competitive framework that, let's say, the Russians or Ukrainians are. And please recognize, again, Japan is a major buyer of U.S. wheat. And so we have to be concerned about this as we move forward in time. On my next slide, which is almost my last one, so please bear with me. Again, this is the same export bid price that I've been explaining before. This is the FOB price. So this is loaded on the vessel, does not include the freight costs. But I wanted to give you an idea that the wheat market is much more complex, even though there's some similarities and competition that goes on between these different suppliers of wheat in the global market, that there tends to be a little bit more price discrepancy. And so if you're a wheat shopper in the global market, you're getting a lot more diversity of bids. And I also wanted, again, just as a reminder, if you look at the gold line, which is the Ukraine, and kind of hidden behind that is the dark blue line, which is Russia, you notice that the price, again, loaded onto a vessel as they entered their harvest season, suddenly dropped pretty dramatically. And so up until most of the early spring months, U.S. hard red winter wheat and the Ukrainian and Russian wheat were very closely priced together. But as the Russian harvest and Ukrainian harvest started now, they've had a pretty substantial price drop. And again, in an attempt to try and push some of their product through the supply chain. So my last slide, and I'd be happy to try and take some questions, is just a reminder that, again, tomorrow at 11 o'clock Central Time, USDA will release both the WASDE report, that supply-demand estimate, as well as an update for the production numbers. And so with that, I'll kick things over to Tim Petrie.
Good afternoon, everybody. Tim Petrie here, NDSU Extension Livestock Marketing Economist. Go to my first slide and just kind of an update on slaughter steer prices. 2 weeks when I talked to you, I said that, there was going to be pressure on prices, and I showed you an estimate there, which did hold true. And, last couple of weeks, again, been kind of tough. So we're at the lowest level. The red line, I should explain there, of course, is this year's prices compared to the gold line last year and the green line 2018. But anyway, we've fallen off, and the seasonal price pattern is for slaughter steer price to go down and probably go down into September. So I just wanted to touch on that a little bit. And, of course, I'm going to talk about some of the reasons here in a minute, and Brian alluded to those as well, as the backlog of cattle and the slaughter capacity and so on. But, I think we've probably are near the bottom or reached a bottom here. There are some indications of that, and that we could even improve contra-seasonally. You see the futures market there for the fall for August and October and December are higher, and even up into August, up just a little today, up above $100. And so that's a signal for a recovery. Up in the upper right hand part is what they've been doing this week, and some information there. And so far this week, last week we were right at 95, and on a cash basis live weight, so far this week through Thursday we were just up a little bit. But the big changes for cattle up here that we sell on a carcass basis, you see last week at 153.44, and this week that's in that blue circle up there. So far through Thursday we're up at 158, so about a $5 increase on a carcass. So I think probably we have reached a bottom there, but again we got to keep slaughter going and so on. So hopefully then we can see some seasonal improvement again. By the end of the year, we're right now still a lot lower than we were the last 3 years, and so we'll have to wait and see what happens there. We can do better than that. The futures are always pessimistic, and they're looking at the COVID situation and the backlog we have, and exports are a concern too, that I'll talk about in a minute. But we can do better than that, but things have to come to light. So move along to the next slide. Brian talked about slaughter, and slaughter has recovered on the top there quite nicely for slaughter steers, and not that much lower than the average or a week ago. But one of the dilemmas we have with this backlog is where seasonally high slaughter occurs right now in the last couple of weeks and this week, and so we're already close to capacity on a normal time frame, and so to increase capacity is very difficult, particularly like Brian mentioned, in the light of the COVID situation and so on. Unlike on the hog side, that we're at seasonally low slaughter levels in July on the hogs, and so there's room there, some extra capacity that we could kill some more, but we're usually at high capacity levels, and that further restricts our ability to kill more cattle. On the bottom side, again, shows you the backlog we have. We still have very high steer dressed weights, meaning that the cattle have been on feed for over 150 days that I talked about last time, and so we got a backlog to get through, and that's why prices are struggling. But we did come down last week, and even this week now it looks like a little bit. So hopefully we can keep getting through the backlog. Go to the next slide. On the export, the new export numbers just came out this week, and again they're behind, so we just got the May numbers. And back a month ago when I talked to you about the April numbers, I said we were really expecting beef exports to decline in May because of the high prices, and in fact they did fall off quite dramatically because slaughter was very restricted and we had high prices, and I'll discuss that in a little while. And so our expectations were for them to fall off, and below, actually they fell off to all major markets, you know, starting with Japan and Korea and Mexico and Canada. Mexico also has got problems with the peso, and high prices, of course, particularly affect Mexico, but other places as well. But we are expecting exports to pick up. So go to the next slide. Here just shows you why our exports did fall off quite dramatically, is because the beef cutout prices, you know, really skyrocketed there when slaughter plants closed down and we had lower supply. But they have, Brian mentioned this, our cutout value has dropped now actually in the last couple of weeks below last year and below average. So that's going to stimulate more exports for sure. And let's go to the next slide. Then these weekly, we do get some weekly numbers on beef. They're not official. The previous ones I showed you on a monthly basis, they're official. These are not official. This is just kind of an estimate of orders that came in, but you see just in the last couple, 3 weeks here, we've spiked export orders back up to where they were previously, back more to the beginning of the year. So that's another indication. I think our exports are going to rebound. The cure for high prices, and we brought those high prices down, and so our exports are likely June in particular into July to get back up. Hopefully we can again continue this pace, because we've got a lot of beef and still probably have near record levels to get rid of, but at least this is an early good indication. So go to the next slide. We're going to kind of just look at pork as a competing meat to beef. And again, our pork exports on top were off a little bit in May. However, they're still at record levels for May, and you see there on the bottom that, you know, just a lot of business into China, in spite of the fact that we still have some tariffs to continue with. China needs pork and are taking a lot from us. And, you know, we talked about that last time as well, and Frame did, is that one of the top commodities now that China is taking from us under phase one. Go to the next slide then. Going to kind of switch gears here and talk some of the new Drought Monitor just came out today. It's as of Tuesday of the week. So on the left-hand side, you see, you know, the darker the color, the more drought. And so you see drought down there from Texas and Oklahoma and up into Kansas and so on. And even up here on the right-hand side, I've showed you this before, but the dark green is our major cow-calf producing areas, and then the red dashed lines are drought. And so up there in this red circle, about a fourth of our beef cow herd is in a drought. And so that's something that we have to watch. And, you know, will probably certainly mean that we don't expand the herd this year, and, you know, see what happens here. And if it gets worse, you know, that could affect some seasonal price patterns with more cattle moving and so on. We have some good news, a little bit of good news for our area. So switch to the next slide. You know, it has started raining again in North Dakota. So here's the last couple of weeks, and, you know, it was so dry, particularly in the western part of the state. I'll show you in a minute, but along the river there, we've picked up substantial rains there of, you know, 5 inches or so, and or more, up to 6, 7 inches in places. Again, the southwest, not as much is the far southwest and west, and you know, not as many cattle up in the northeast, but actually got too much there. But the good news is we know now it can rain. We've got some rain. Go to the next slide. And this is just comparing last week's North Dakota Drought Monitor to this week's. This week's new one out today is on the right, and last week's is on the left. So we've seen drought conditions improve significantly. Way on the left-hand side, a week ago, we had 53% in D1, which is, you know, we're getting really dry. And so we go to the right-hand side. That's now down to the D1 is down to 18%, so a reduction of 35%. Still about the same none there on the eastern side of the state at 29%. And last week there you see right around Burley, Oliver, and Morton counties, we had went into D2 status, which is very, very dry, and that's talk about in a minute, but that's from a USDA livestock forage program, has some significance. Go to the right-hand side, though, that was eliminated by the rain, so we don't have any D2. Why D2 is significant, as you see there, kind of on the bottom for our FSA disaster eligibility, we have to be in D2 for at least 8, and that's consecutive weeks. So we blew that out of the water. We're not consecutive anymore because we don't have any D2. So hopefully we don't go there. But if we do, we have to start all over to look for any an assistance there, or we would have to go to D3 or D4 to get some assistance. So, the good news is it can rain, and it did rain. Kind of, maybe another consideration there is we were, looking at trying to get some CRP open possibly early and so on. And from a political standpoint, moving away from the D2 status and getting rains does not help that cause a lot. But anyway, it did rain, and that's good news. I realize that we still going to have a short hay crop, and we've still got some problems with grass and so on, and so that certainly is a concern. So go to the next slide. Just to kind of finish up here on cow prices, again, we have been moving quite a few cows in western North Dakota where it was dry. The good news is, we've increased seasonally on cow prices, and actually last week they were higher than the last couple of years. So for our forced movement of some cows, at least we've had, the prices haven't been in the doldrums there, and so moving cows has generated some money. And so just finish up here with the next slide. And, Brian mentioned the packing plants getting back to normal and so on. And so just kind of end up on a light note here is, the Hormel plant and the other plants that he talked about on the hog side down in Minnesota are open in business. And even Hormel is feeling good enough that they've opened up their spam museum. So if you're out traveling, you can stop in there. And with that, let's go to Dave Ripplinger to finish up there with ethanol.
Thanks, Tim. David Ripplinger, Bioproducts, Bioenergy Economics Specialist. Again, just a short update on what's going on in the corn ethanol market. Probably first and foremost, in terms of what's going on, we really have recovered significantly from the shock from COVID. Days in storage are about where they are more or less during normal periods after building up substantially as we saw production not declined as fast as use did, but things are certainly in balance. We actually had an increase in days in storage for the last reporting period, which ended last Friday. Looking at what's going on in terms of margins, a little bit stronger if we just go on to that bottom line where for every bushel that a corn ethanol plant in South Dakota crushes, they are making a bit more, 8 cents more a bushel, a 6% increase over last week. They're paying more for corn, they're getting more for ethanol, and they're getting more for distillers grains across the board. And actually that ethanol number lags almost a week, and we've seen a lot of positive movement in that contract, the futures contract in Chicago, which is definitely optimistic. Things are moving in the right direction. The industry is kind of back on its feet, is for the most part profitable, as we've seen more production come back online, and they are paying more for corn at the same time. Just looking kind of what's been going on, or kind of just kind of retrospective on what happened with COVID this year. we had that rapid decline in production, trying to match the decline in use. The low was that second half of April. On an annual basis, production was 8.2 billion gallons, which is about half of nameplate capacity here in the United States. Since then, it's been a pretty steady and swift return to close to where we were before. Production's now up 70% off that low to 14 billion gallons a year. Again, not to what it was a year ago, and also not to what capacity is, but clearly moving in the right direction. Going back to some of Brian's remarks about the growth in positive test rates and positive numbers, exactly what that's going to mean. Is there going to be a second wave, and what that might mean to personal travel, either if there's new stay-at-home orders, or just a decline in economic activity, folks not wanting to recreate. And of course, too, we have that eventual suspension of, or the expected end of the $600 a week unemployment kicker, which could also impact things as well. And also, too, we're in the middle of summer, and summer is the driving season, and so use is higher. What's going to happen 8 to 10 weeks from now is really unknown. Just to kind of do some quick math on what happened, before COVID really hit, so the first 2 months of the year, production and kind of correspondingly use was 4% higher than it had been a year previous. If we would have expected that to continue, we would have actually used, or would have produced almost 1.5 billion gallons more ethanol from March and through last week. Obviously, that didn't happen, and consequently, basically what that meant is we didn't use 500 million bushels of corn in the country that we would have expected to otherwise. That's in the ballpark of what North Dakota produces each year, plus or minus, and a little over 3%, 3.5% of U.S. production, which is basically just gone, water under the bridge. Of course, the WASDE comes out tomorrow. We'll see. They've been lagging a little bit on their corn ethanol use numbers. We'll see if they catch up a little bit, but clearly that's a major loss to the industry. We'll see exactly what happens moving forward. Once again, I want to thank everybody for coming back today and handling the transition to our Thursdays. We're going to continue this for the rest of the summer. So from now until Labor Day, every 2 weeks on Thursday, beginning at 12:30, we'll be having this webinar. You're all welcome to attend, and feel free to share information about it with any of your colleagues if you think they find it interesting. Again, the dates that we're going to be meeting for the rest of the summer are on the screen. With that, I'd like to move into the question and answer, if there's any of those today. And we just got a question come up, which is great. Again, please feel free to use the Q&A tool or the chat if you're more comfortable with that. Before we move into questions, I'll just remind you too, there is a short survey. And then also, if you have any interest in any of the previous webinars, you can find those online, both a recording of the webinar as well as the slide deck itself, if you have any thoughts about what might have happened in the past. So with that, I'm going to flip over to questions here. And so our first question, any thoughts on the volume of prevent plant and impact across the board, including elevators' ability to offer storage? So Frank, I figure that's for you.
Yeah, probably. So I did some back calculating. So based off of the numbers in the acreage report and what we have for typical planted acreage across the state, my rough estimate is that we came up with about 2.1 million acres of PP this year in the state of North Dakota. And I know I talked a little bit about that in a previous webinar. If you look at kind of the 10 and 15-year average, we typically in the state have anywhere from 1 to 1.2 million acres of PP. So to move, in the March report, embedded in that was about 800,000. So even in March, when farmers were surveyed, we were expecting some prevent plant acres this year. Just because of the lousy spring we had, especially in the eastern part of the state, those PP acres increased pretty significantly, again, based on this back calculating. We won't have any official numbers until later this fall when after farmers certify their acreage with FSA. That's what kind of the official reporting. That's usually the number that a lot of the market traders will use, because FSA publishes the compiled numbers over time. So we won't get an official reading until later on this fall, but based on my kind of back of the envelope rough calculating, it looks like we got about 2.1 million acres of PP. And a lot of that, of course, is in the eastern portion of the state. So when we talk about the impact on storage, whether that be commercial storage or on-farm storage, it's going to be very localized. I know there's particular counties and particular areas where, I've heard estimates as large as close to 50% of a particular county or regional is going to be in PP. So obviously that will have a large impact on the ability to offer storage. So it's very tough to know without kind of being a bit more geographic specific. I do think that given what we see right now, again, with the carryover stocks and the grain stocks report that we saw on June 30, our inventories for both on-farm and off-farm inventories for both corn and soybeans are down a little bit from the same time last year. And part of that is, of course, we had lower yields. We've been able to push a little bit more grain through the system. So I don't personally anticipate there's going to be any major storage issues with capacity. I think we'll have enough capacity. I don't expect, unless the corn crop gets to be much bigger than I expect, I don't think we're going to see a lot of piling on the ground this year. So will the elevators be offering any kind of storage incentives? I think a lot of that will depend upon the export market, because typically when they provide storage incentives for like delayed pricing contracts or actually incentives for low cost storage at the elevator, they're looking at the opportunity to be able to buy that, store it, and resell it at a later date, meaning really it's an export market that they're trying to capture. So that one's a little touchier to try and figure out exactly, but from a capacity standpoint, I don't see that we're going to have any major limitations.
Thanks, Fran. I don't see any other questions right now. Are there any other comments the panelists want to make, thoughts that came to mind during the presentation? One I actually did a little bit of math before we met. It's 330 miles from Berry Hall to the Spam Museum. So getting about average mileage for a car, that's a gallon of ethanol each way. So if everybody makes that trip, and if you do think that the quarantine or stay at home or Corona's lasted a long time, I bet you your Spam in your pantry is probably still good. If there's not any more questions, I want to thank all the panelists again for participating. We'll be back in 2 weeks for the next round. And I hope all of you who attended, we made good use of your time, and I hope you have a great weekend. Thanks.